Hello, my name is Michael Bray. This is the Week 3 Assignment Market Recognition, Full Sail University for Patterns and Recognition class. Dunkin' Brands Group Incorporated operates as a franchisor or quick service restaurants which engage in the service of hot and cold coffee, baked goods, and ice cream. The stock ticker for Dunkin' is DNKN, and it is a part of the NASDAQ trading market. It operates as the following segments: Dunkin' US, Dunkin' International, Baskin-Robbins International, Baskin-Robbins US, and US Advertising Funds. The company was founded in 1950, headquartered in Canton, Mass. It's a picture of the first Dunkin' in Massachusetts. Dunkin', or DNKN, has been experiencing overall continued growth over the last 4 years, and that has looked to be the case at the beginning of 2020. However, the stock price continued to reach the new highs as it reached $84.74 a share towards the end of 2019. It looked to keep an upward trend. However, due to the coronavirus outbreak, COVID-19, the stock price has plummeted over the first quarter of 2020, which we will get into in the following slides. So you can see here the Dunkin' stock data, what its industry is, on which exchange it trades on, the sector. There's a target that was applied from the NASDAQ and Yahoo Finance, as discussed, the 52-week high, and currently the stock price is just under $40 a share. This is as of March 20th. Correlation analysis. One of the most important indicators for the stock is the correlation between the stock itself and the market in which it resides. In this case, Dunkin' is a part of the NASDAQ. As you can see below in the following two figures here on the left-hand side, the NASDAQ performances are similar to the performance of Dunkin'. This line graph shows similar characteristics over the last 50 days. We can see at the beginning of March, both Dunkin' and NASDAQ took sharp drops. This is primarily due to the outbreak of the coronavirus. It started hitting the U.S. at the beginning of March, and at the time, states and companies started taking measures to stop the spread of the virus, resulting in the closure of stores and restaurants, allowing a to-go or online orders. The overall correlation here is that Dunkin' represents a similar drop to NASDAQ, which suffered from. Had Dunkin' dropped in market price and the NASDAQ gone up, there would be concerns for this stock. But since they're not, the concern is relatively low. Whale tracking. With Dunkin' being a coffee shop restaurant for all-day breakfast services, it is considered a consumer discretionary stock. A consumer discretionary stock is defined as the term given to goods and services that are considered non-essential by consumers, but desirable if their available income is sufficient to purchase them. That being said, Dunkin' Donuts, people go there for coffee when they can easily pay for it at home or make it for themselves at home, yet they go out and pay for it. They also will get breakfast on the go instead of making breakfast at home, a relatively cheaper alternative. Therefore, it's a consumer discretionary stock. The figure here represents the fund allocation for whale index, which provides investment strategy based on the whales in the stock market. This figure shows that consumer discretionary stocks represent about 15% of the fund allocation within the index, trailing behind information technologies and communications. This shows that there's not whale tracks associated with Dunkin' Donuts. Support resistance levels. Dunkin' has been on an upward trend over the last 4 years, dating back to 2016. The support has been kind to the stock price. It has not found a bottom on the floor. As you can see here, the trajectory line that I placed, there's no real bottom where it hits it and it bounces back up. Instead, it indicates a positive and upward trend. Over the last 5-year outlook, on average, the ceiling has seen an incremental increase over that time period. And the figure below, or the figure on the screen here, represents the upward trajectory. With the virus outbreak playing a major impact on the stock market in general, Dunkin' has suffered like most of all the stock prices have. As you can see with the call out March 20th, what the stock price is, it took a dramatic hit. There's no doubt in my mind that this trend would have continued if you look at the historical performances dating back to 2016. Bollinger Bands. First, we must calculate a simple moving average to figure out what Bollinger Bands are going to be. Next, we got to calculate the standard deviation over the same number of periods as the simple moving average. For the upper band, you got to add the standard deviation to the moving average. For the lower band, you subtract the standard deviation from the moving average. In this case, we are going to do a long-term Bollinger Band, which is a 50-day moving average and bands at 2.5 standard deviations. That definition comes from Bollinger Bands from TD Ameritrade. And here the figures on the screen depict what our stock price is as of March 20th, what the average close has been over the last 50 days. So a huge disparity there because of the sharp decrease in the beginning of March. Standard deviation over the 50 days, the upper band formula, the result was 96.06, and the lower band formula, when the result of 45.76. Buy, sell, or hold. Stock price for Dunkin' will most likely continue to go down. However, this would be a good price point to enter the market and purchase shares of Dunkin' if that was an option for you. With the global pandemic of COVID-19 hitting all industries hard, especially the restaurant sector, prices should rebound, given the assumption that the world will go back to normal eventually. Normal could represent something of an $84.74 share at a 52-week high, and an average of $70.91 a share over the last 50 days. With a price point of under $40 a share as of March 20th, there's a path forward to making close to $30 per share in equity. My recommendation would be to buy Dunkin' as it is such a low price right now. Outlook. I see the stock price for Dunkin' continuing to go down in the near future, which I just talked about. With market volatility playing such a big role in the global markets, Dunkin' will continue to ebb and flow with those markets, as we see in the NASDAQ. Ultimately, the bottom of the stock will find a resting point. I do believe the floor is at a lower point than it currently is. Back on June 28, 2016, that was the last time Dunkin' was this low. As you can see, I have a call out here on the left-hand side. Almost 4 years Dunkin' has been on an upward trajectory. With COVID-19 affecting almost everything in the markets, Dunkin' is relying heavily on customer interaction for everyday purchases in stores. The stock price will continue to suffer in the near term. From January to February, the average price dropped 4%. From February to March, the average price dropped 21%. In a month's time frame, the average stock price could be at around $50 a share, with the standard deviation equating to an average of $34 a share. So when we apply standard deviation, the low end could be at $34 a share, which is lower than the current stock price right now. This is based on the increasing of standard deviation from 1 to 10 from January to March, and in the anticipation that the standard deviation could grow to 16 a month from now. As you can see here on the screen, what I have is at the top represents the average stock price for January, February, and March. As you can see, it goes from 78, 75 to 59 from left to right. And on the bottom, the standard deviation is growing based on the average stock prices volatility from day to day, from 1 to 3 to rounded up to 11. A year from now, the stock could theoretically rebound from its current losses of over $45 a share. That's how much loss they're at right now. A rebound of at least 50% would be ideal, as it would equate to roughly $62 a share, which aligns with the stock price after the sizable dip back in December 2018. In this time frame, from December 6th to December 24th, Dunkin' took a 15% hit, while this current time frame that we're in is going to take a much more substantial hit than 15%, as they're currently in almost 50% loss right now per share basis. Something along these lines of a major drop over the span of 2 weeks could represent what the next ceiling could be once the stock comes back a year from now. Thank you very much.